You're staring at the screen. 2 losses in a row. Suddenly, the market feels heavier. Your confidence wavers. You tell yourself, I'll get it back on the next trade. That, my friend, is the trap. Most amateurs see losses as numbers on a chart. Professionals see them as signals. A 2-loss streak isn't random, it's a psychological barrier. Dopamine spikes, fear creeps in, and risk tolerance quietly changes without you noticing. That's why nearly 72% of losing streaks spiral into bigger losses. Let me tell you a story. Jesse Livermore once took 4 winning trades in a row. By the 5th, he felt unstoppable. But the 5th trade wasn't part of the streak, it was the reset. Dopamine had tricked him. The market didn't change. His psychology did. This invisible shift is what separates amateurs from professionals. Amateurs see the chart, feel the pain, and respond with impulse. Professionals see the same chart, feel the same pressure, and respond with process. Here's the brutal truth. If you ignore the 2-loss wall, you're gambling with your account, not trading. Professionals hit the same streaks, but they pivot. They stop, reassess, and let patience do the work. Amateur behavior, chasing the loss, enlarging position size, hoping for a miracle. You've seen it happen. A trader hits 2 losses, then increases position size, hoping that fortune will reverse. Rarely does it. What usually follows is the 3rd and 4th loss, often larger than the first 2 combined. The psychology behind this is straightforward yet insidious. After the 2nd loss, your brain has already started adjusting risk tolerance. Unconsciously, you think you're acting deliberately, but your instincts are bending rules, inflating confidence and blurring discipline. Understanding the 2-loss wall begins with recognizing that losses are not just numbers, they are signals. Each loss communicates something about your timing, your strategy, your psychology. Amateurs dismiss this message. Professionals read it. They ask, what changed in my behavior? What is the market teaching me? The answer is never immediate. It requires awareness, humility, and a willingness to step away. This is why patience is a professional's weapon. It converts a potential spiral into an opportunity for control. Let's explore the mechanism behind this. Dopamine, the chemical that rewards our brains for success, spikes after wins. It creates a subtle overconfidence that we rarely notice consciously. When the next trade is a loss, the sudden contrast triggers a cascade of emotional responses: fear, frustration, and the urge to compensate. Your risk tolerance inflates unconsciously. You increase size, tighten stops too loosely, or chase entries without confirmation. All of these are silent account killers. Professionals anticipate this pattern. They know that after 2 consecutive losses, the first instinct is the most dangerous. The second instinct, after stepping back and analyzing, is the one that wins. Consider another scenario. A trader experiences 2 small losses in a morning session. Amateur instinct says, recover now, or I'm behind. They force trades, let emotions dictate entries, and ignore position sizing rules. By the afternoon, a minor drawdown has grown into a major one. A professional in the same scenario pauses. They might step away entirely for 30 minutes, review the tape, check setups against their rules, and re-enter only when the probability aligns with their plan. This pause does not cost them opportunity, it preserves capital. And in trading, capital preservation is the first step to long-term profit. History is filled with examples. Livermore's 5th trade after 4 wins serves as a cautionary tale. Even the most disciplined traders can fall prey to internal, invisible shifts in psychology. What separates sustained winners is their recognition of the pattern and their commitment to a systematic response. It's a difference of identity, amateur versus professional. When you hit 2 losses, ask yourself, are you chasing ego or process? The answer determines the outcome of the next dozen trades. There is a hidden rule here. The first trade after a loss streak is not about profit. It is about mental clarity. Professionals do not seek to make back losses immediately. They seek to re-establish control. They may sit on the sidelines, journal their mindset, and only act when the setup meets every criterion they set before. This is counterintuitive to most traders, who believe action equals progress. In reality, inaction is often the most profitable trade. Doing nothing in the moment is doing everything for the next opportunity. The danger of ignoring the two-loss wall is not just financial, it is psychological. Every forced trade chips away at discipline. Every oversized position builds overconfidence that is ready to collapse. Over time, small errors compound into catastrophic losses. Amateurs often don't notice until it's too late. Professionals, in contrast, view losses as feedback, as signals to recalibrate. They know that the market does not punish rules, it punishes impatience. The mechanics of the two-loss wall are subtle yet undeniable. After the second loss, your mind begins recalculating risk without your consent. You might increase position size, override stops, or chase setups that do not align with probability. These decisions feel rational, but they are chemically biased. Awareness of this pattern is the first step to breaking it. By recognizing the signs early, traders can implement protocols that halt the emotional spiral. Let's dig deeper into the psychology. Dopamine creates a false sense of security after wins. After losses, cortisol spikes, triggering fear and urgency. The contrast between these chemicals disrupts judgment. Amateurs believe their skill has failed. Professionals know it's a temporary imbalance, one that can be neutralized by pause and protocol. By understanding these chemical responses, traders gain control over their reactions, rather than letting reactions control their capital. The identity contrast cannot be overstated. Amateur thinking is transactional. I lost money. I must earn it back now. Professional thinking is systemic. I lost. How do I preserve capital, reset, and re-enter under optimal conditions? One mindset leads to spiraling losses. The other leads to sustainable growth. Recognizing which mindset dominates after two losses is a key differentiator in long-term success. Here's a paradox. Many traders believe that trading after a loss streak is about opportunity. The reality is the opposite. The first opportunity after two losses is inaction. Sitting on hands, reviewing trades, checking the tape. These actions may feel like lost chances, but they are actually building the conditions for profitable execution later. Professionals leverage this pause to restore clarity, confidence, and discipline. Amateurs see it as failure. The two-loss wall also exposes hidden patterns in risk management. Traders often adjust stops too loosely, hoping to capture a reversal. Position sizes creep upward unconsciously. Each decision, small as it seems, compounds the risk. Professionals know that after two losses, risk management is more critical than market opportunity. They tighten stops, reduce position sizes, and focus only on high-probability setups. By doing so, they prevent a small negative sequence from growing into catastrophic drawdowns. Consider this. If a trader's typical loss is 1% of their account, two consecutive losses are 2%. If they react impulsively and increase size to chase, the next loss could be 4 or 5%. This escalation is why nearly 72% of amateur streaks spiral. Professionals avoid this by implementing strict rules. Stop after two losses, pause, reassess, and re-enter with micro positions. Discipline trumps urgency every time. Finally, the hidden rule emerges. The first step after the two-loss streak is not profit. It is control. Control over emotions, control over risk, control over process. By prioritizing control, professionals safeguard their accounts and their psychology. Amateurs ignore this principle, letting emotions dictate trades. The difference in results is stark, measurable, and repeatable. By the end of this reflection, you should understand that two losses are not merely setbacks, they are signals. They are the market's way of testing your discipline. Recognizing this allows you to pivot, reset, and prevent small mistakes from compounding. The next step explored in Chapter 2 is a practical method to immediately halt the spiral. a step that can save 50–80% of your account from being destroyed by impulsive reactions. For now, remember, the two-loss wall is real. It is dangerous, but it can be mastered with awareness, pause, and the discipline to act only when the conditions are right. The secret weapon against the two-loss wall isn't fancy indicators, it's a mindset and a rule. Stop, reset, reassess. Imagine this scenario. You've just lost twice. Your first instinct screams, "Double down. I can win this back." That's the amateur speaking. The professional, however, pauses. He doesn't just exit the trade. He steps back from the entire market, stops trades, checks the tape, reviews position size. This isn't weakness, it's precision. The market doesn't care about your feelings. It only reacts to probability, alignment, and discipline. When emotions are high, probability is irrelevant. The difference between amateur and professional is clear. Amateurs act impulsively. Professionals act systematically. Step 1 is the immediate stop. Close all active positions if your account hits a predetermined loss threshold. Do not negotiate. Do not rationalize. This is not punishment. It's prevention. Every minute you hesitate increases risk. A small loss can compound into a large one before you realize it. Professionals define this threshold before they ever touch the charts. They treat it as a sacred rule. Amateurs, in contrast, set no boundary. They trade until the account screams. Numbers don't lie. Traders who set a stop threshold after 2 losses reduce emotional errors by more than 60%. That's not anecdotal, that's statistical evidence. Step 2 is the mental reset. Take 15 to 30 minutes away from the charts. No news, no chat rooms, no justifying past mistakes. This period is non-negotiable. Your brain needs to recalibrate. After losses, dopamine and cortisol distort perception. Impulses masquerade as opportunity. The pause clears that fog. Professionals often use this time to journal. What went wrong? What emotions were triggered? Which rules did I violate? This clarity isn't optional, it's foundational. Amateurs rarely take this pause, and their next trade suffers as a result. Step 3 is reassessment. Review your trading plan carefully. Was this a rule violation? Did you risk too much? Were your position sizes appropriate for the setups? Professionals answer these questions honestly, without ego. They dissect the trade emotionally and technically. Amateurs skip the analysis, hoping luck will fix the loss. The professional's reassessment doesn't just correct a single mistake. It recalibrates the mind for all future trades, ensuring that one streak does not spiral into another. Step 4 is restart with discipline. Return only when the setup meets every criterion you've defined. Nothing less. Position size must match risk tolerance. Tape must confirm direction, and stops must be logical. There is no shortcut. The first trade after a loss streak is about process, not payout. The professional understands that rebuilding discipline is far more profitable than chasing immediate wins. Every impulsive trade after a loss is an opportunity squandered. Amateurs ignore this, trading recklessly and increasing exposure. This is the difference between accounts that survive and accounts that collapse. The proof of this method is measurable. Traders implementing the stop and reset protocol avoid revenge trades, oversized positions, and catastrophic streaks. Over 60% of emotional errors vanish when the protocol is applied consistently. Amateurs, by contrast, compound losses with each reactive trade. Consider a trader who hits 2 losses in the morning and ignores the reset. By midday, their account can easily be down 5–8% more than necessary. The professional would have paused, journaled, and returned only to high-probability setups with controlled risk. It's not about avoiding losses entirely. It's about controlling the reaction to them. Here's a maxim to remember. 2 losses are the market's test. How you respond defines your next 100 trades. It's not the loss itself that matters, it's the pause, the reassessment, and the disciplined restart. Many traders feel unnatural stopping. Doing nothing seems like failure. Yet in trading, doing nothing is often the most profitable trade. This is a paradox that challenges every amateur's instinct. Your impulse tells you action equals progress, but in reality, measured inaction builds both capital and confidence. The psychological mechanics behind this are subtle but powerful. Dopamine spikes after wins, creating an inflated sense of competence. After losses, cortisol rises, triggering fear and urgency. This chemical contrast distorts judgment, prompting impulsive, high-risk behavior. Professionals anticipate this pattern and use the stop and reset to neutralize it. Amateurs, unaware, let hormones dictate decisions, compounding mistakes. By mastering the protocol, the professional transforms a weakness into a strategic advantage. The pause is not passive, it's active preparation. Another element of the protocol is its impact on risk management. After 2 losses, the amateur often loosens, stops, or increases size unconsciously. Each small deviation increases vulnerability. Professionals tighten stops, reduce position sizes, and focus only on setups that align with probability. They understand that account preservation is the first rule of recovery. The market doesn't care about desperation. It rewards discipline. Each controlled trade post-reset reinforces confidence and stabilizes psychology, creating a foundation for future opportunities. Let's consider a scenario. A trader suffers 2 consecutive losses early in the session. The amateur immediately hunts for the next trade, increasing position size to recoup. The result is a forced loss, eroding capital further. The professional pauses, resets mentally, and reviews the tape. 15 minutes later, a high probability setup forms. Position size is controlled, stops are tight, and execution is deliberate. The trade succeeds, not because of luck, but because process overcame emotion. Micro wins like this rebuild confidence while minimizing risk. Over time, these disciplined actions compound into sustainable profitability. The stop and reset also preserves psychological clarity. Every trader experiences streaks, but the professional reframes them as feedback, not failure. Amateurs internalize losses, associating them with skill rather than process errors. This distinction is crucial. By removing ego from the equation, traders maintain composure, observe tape objectively, and execute plans with precision. Discipline becomes a self-reinforcing cycle, and losses no longer feel catastrophic, they feel informative. Here's another paradox to embed. The first trade after 2 losses should never be about profit. It should be about restoring control. Profit comes as a natural consequence of disciplined action. Many amateurs violate this principle, forcing trades to recover quickly. Professionals prioritize control over immediate reward. By doing so, they protect capital, confidence, and long-term viability. It's a subtle but profound shift in mindset, one that transforms the way streaks are approached. The stop and reset protocol also teaches humility. Each 2-loss streak is a reminder that markets operate independently of our desires. Emotional impulses are secondary to probability, alignment, and risk management. Professionals acknowledge this truth, submitting to the process rather than the outcome. Amateurs fight it and pay the cost. This humility compounds into smarter decisions, better timing, and fewer catastrophic errors. Finally, the hidden power of the protocol lies in its simplicity. No complex indicators, no secret algorithms, just 4 steps. Stop, reset, reassess, restart. By repeating these steps after each 2-loss streak, traders embed discipline into muscle memory. Over months and years, this consistency compounds. Losses shrink, confidence grows, and accounts stabilize. Amateurs rely on hope, professionals rely on rules. The difference in results is staggering, measurable, and repeatable. By the end of this reflection, the takeaway is clear. The 2-loss wall does not punish skill, it exposes reaction. 2 losses are a psychological trigger designed to test discipline. Implementing the stop and reset protocol halts the spiral, neutralizes emotion, and prepares the trader for high-probability setups. The next chapter will extend this principle further, revealing how patience itself can be treated as a tradable position, a counterintuitive yet powerful concept that converts inaction into measurable advantage. The first step after losses is not profit, it is control. And mastering that is what separates consistent winners from those who chase the market blindly. Here's a counterintuitive truth. After 2 losses, your most profitable move may be nothing at all. Amateurs feel pressure to act. They chase setups, force entries, and increase size, thinking action equals opportunity. Professionals understand something few realize. Patience is a position in itself. The market does not reward urgency. It rewards timing, discipline, and clarity. After losses, acting impulsively is the fastest way to compound mistakes. By sitting, observing, and waiting, you are not passive, you are strategically positioning yourself for the highest probability outcome. Consider this scenario. A trader suffers 2 losses in quick succession. His first instinct is to make up the money immediately. He opens positions with slightly larger size than normal, forcing entries that only partially confirm tape and patterns. Almost predictably, the trades drift into stop loss, and the account suffers further erosion. Now imagine the same trader applying patience. He steps away from the screen for 2 hours. He journals his emotions, noting where fear, frustration, and impulsiveness arise. He clears his mind, removes distractions, and allows the market to evolve without interference. 2 hours later, a perfect setup emerges. Price aligns with the tape. Risk is manageable. Reward potential is high. Because he waited, probability is in his favor, and his position size matches a disciplined plan. By doing nothing initially, he maximized opportunity later. The key protocol for treating patience as a position is deceptively simple but difficult to implement. First, set an exact cooldown period after a loss streak: 15 minutes, 30 minutes, or even an hour, depending on your trading style. During this period, the goal is not to watch charts obsessively, but to let the brain reset. Second, journal your emotions during the break. Label fear, greed, doubt, and frustration explicitly. Doing so externalizes the psychological pressure and prevents it from controlling your next trade. Third, treat your mental reset as an investment. Every disciplined pause compounds, reinforcing control, confidence, and clarity over time. Professionals view these moments as productive, while amateurs see them as wasted opportunities, which is why their accounts continue to erode after losses. Psychology underpins this principle more than technical skill ever could. After a losing streak, the brain seeks dopamine relief. Amateurs mistake this need for opportunity and rush trades, often against probability. Professionals recognize the chemical impulse, converting what feels like weakness into a strategic advantage. They understand that the urge to act immediately is a signal, not a command. Responding deliberately transforms emotion into an ally, rather than letting it dictate outcomes. The maxim, patience is a position that pays interest, while amateurs bleed capital, is not a cliché. It's an observable truth in every market condition. Each pause after a loss allows probability to align with execution. Each journaled reflection strengthens discipline. Each decision to wait rather than chase reinforces process over impulse. The amateur, by contrast, takes the exact opposite path, forcing trades that often violate setup criteria and risk parameters. Over time, the difference in results is stark. The patient trader stabilizes capital and psychology, while the impulsive trader compounds losses and frustration. Consider the mechanics of dopamine and cortisol after losses. Dopamine spikes after wins, inflating confidence and risk tolerance. Cortisol rises after losses, triggering fear, urgency, and compulsive behavior. Without awareness, these chemical responses drive action, often misaligned with probability. The disciplined trader recognizes these internal signals and deliberately counteracts them with the patience protocol. Sitting on hands becomes a high-probability trade because it neutralizes emotional distortion. The paradox is clear. Doing nothing now creates conditions for success later. A real-world illustration makes the principle tangible. One trader suffered 2 consecutive losses in a volatile session. Instead of reacting, he stepped away for 30 minutes, journaling every emotion and reviewing his plan. During this time, he noticed patterns he had overlooked in the morning trades. When he returned, he only entered setups that perfectly aligned with tape, risk parameters, and probability. His positions were small, but precise. The result: modest gains that rebuilt confidence and reinforced discipline without risking excessive drawdown. Amateurs in the same scenario would have forced trades to recover losses, often amplifying risk and reducing their probability of recovery. The concept extends beyond single trades. Patience as a position teaches the market that you are a measured participant, not a reactive gambler. It instills a rhythm in your trading, creating a predictable pattern for both psychology and performance. Every period of disciplined waiting compounds into better execution and improved decision-making. Over weeks and months, the cumulative effect of treating patience as a tradable position exceeds the value of many impulsive gains earned by amateurs who act on adrenaline rather than process. There is also an important nested loop here. Patience lays the groundwork for micro-trading setups, which will be explored in the next chapter. Without a calm, reset mind, even technically perfect setups are executed poorly. Waiting is not wasted time. It is preparation, conditioning, and mental alignment. Professionals see this clearly. Amateurs see only inaction and perceive lost opportunity, which often leads them back into the same losing pattern. Implementing patience requires both awareness and discipline. Start with clear rules. Define a cool-down period after losses. Commit to journaling, and treat the mental reset as a productive step. Use this time to reassess broader market context and confirm that your setups align with tape and probability. Professionals use the period to filter out setups that would otherwise be impulsively taken and often misaligned. Amateurs ignore the step, forcing trades, risking capital, and increasing psychological strain. Another paradox emerges. The very act, waiting, feels counterintuitive, especially after emotional losses. The mind wants action because it interprets stillness as stagnation. But in trading, action without alignment is destructive. The patient trader understands that stillness is not stagnation, it is strategic positioning. By waiting, he transforms potential weakness into a position of strength, increasing the likelihood of capturing high-probability opportunities without risking additional emotional or financial drawdowns. The protocol also reinforces a professional mindset. Each period of deliberate pause strengthens self-control and builds resilience. Amateurs act impulsively and reinforce habits that perpetuate losses. Professionals treat patience as a repeatable action, compounding discipline over time. Each cool-down, each journal entry, and each delayed trade reinforces a mental framework where probability dictates action, not emotion. Consider a session where multiple setups appear after a 2-loss streak. The amateur jumps at each, often violating criteria in the rush to recover. The professional waits, evaluates probability, and selects only the most aligned setups. Execution is precise, risk is managed, and small wins begin to rebuild confidence and account stability. The difference is measurable, repeatable, and rooted in process, not luck. By the end of this reflection, it is clear that patience is a strategic tool, not a passive state. After 2 losses, the first trade is often sitting on hands, journaling, and observing. This creates conditions for higher probability setups, reduces emotional trading, and preserves both capital and confidence. Patience transforms what appears to be inactivity into an actionable, profitable position. The next chapter will expand on this principle, linking mental discipline to tactical execution through micro-trades, consolidating both confidence and account protection, while building the foundation for long-term success. Understanding patience as a position bridges psychology and process, turning internal control into measurable advantage and reinforcing the core distinction between amateur reaction and professional response. After patience comes execution, but not recklessness. The next step is tactical. Small, high-probability trades designed to rebuild both confidence and account integrity. Amateurs often chase large moves after losses, thinking they must recover quickly. This impulse frequently leads to oversized positions, poor alignment with tape, and another cascade of losses. Professionals, in contrast, start micro, tiny positions, controlled risk, tight stops. They understand that consistency, not hero trades, compounds wealth and psychological stability. Recovery is a process, not a sprint. And each carefully executed microtrade restores discipline as much as it rebuilds capital. Consider a trader who just completed a cooldown after 2 losses. He spots a high probability setup. The tape confirms alignment. Risk is small. And the stop loss is precise. He enters 0.5% of his capital. The trade moves in his favor, earning 2%. Not a windfall, but the gain reinforces process over ego. Confidence returns gradually, while prior losses shrink in psychological impact. By keeping size small, the trader maintains control over outcomes and avoids the temptation to overcompensate. Each winning microtrade is a lesson in discipline, demonstrating that account preservation is as valuable as profit itself. The protocol for microtrading after a loss streak is simple, but requires vigilance. First, identify setups with clear confirmation. Nothing should be forced. A setup without alignment is a disguised risk, a trap for impulsive traders. Second, keep position size conservative. Never exceed 1 to 2% of the account on early trades following a streak. This constraint prevents emotional overexposure. Third, review every trade meticulously. Did the process succeed? Did emotion influence the entry or exit? Reflection is mandatory. Finally, scale only after consistent adherence to rules is proven. Increasing size without confirmation of process is a shortcut to disaster. Psychology underpins every decision in microtrading. After a loss streak, the brain craves instant gratification and validation. Amateurs attempt to satisfy this need through oversized trades, often ignoring setup integrity. Professionals, however, leverage the pause to align probability with execution. They enter only trades that meet strict criteria, viewing each small gain as a reinforcement of their process rather than a conquest of the market. Over time, microtrades restore confidence and rebuild discipline, producing compounding returns in both account and mindset. A real-world illustration demonstrates the value of this approach. A trader suffers 2 consecutive losses in the morning session. After cool-down and journaling, he identifies 3 small, high-probability setups. Each trade risks less than 1% of his capital. Stops are tight. Entries follow tape confirmation. The trades succeed modestly, but crucially, each reinforces process, not ego. By the afternoon, the trader's confidence is restored. He is mentally prepared to scale positions later in the session if setups align. The contrast with an amateur who chases recovery is stark. The amateur escalates risk, violates stops, and compounds losses, often spiraling out of control. Notice the nested loop. Patience enables high-probability setups. Microtrades solidify confidence. Later, when larger opportunities arise, the trader's psychology is intact. Impulsive overexposure is avoided. Each trade, no matter how small, serves as both execution and psychological reinforcement. Process becomes habit. Discipline becomes default, and emotional volatility diminishes. In other words, small trades are not trivial, they are foundational. The maxim, small trades protect the account, disciplined trades protect the trader, encapsulates this principle. Protection of capital and maintenance of discipline are inseparable. A trade's size is irrelevant if discipline is broken. Conversely, A disciplined approach, even with small gains, stabilizes psychology and reinforces long-term success. Amateurs ignore this lesson, believing recovery requires bold action. Professionals internalize it, understanding that measured execution compounds over time in both profit and composure. Consider risk management mechanics. After 2 losses, emotional bias inflates perceived opportunity. Position sizing creeps upward unconsciously, and stops are often loosened to chase reversals. Micro-trading forces discipline. Size is capped, stops are tight, and risk is quantified precisely. Over dozens of trades, these rules compound into both financial stability and emotional clarity. Each successful micro-trade reinforces control and minimizes the psychological pressure that typically follows a streak. Scenario: a trader experiences multiple setups after a 2-loss streak. The amateur jumps on all perceived opportunities, often violating rules, risking more than intended, and chasing profit. The professional selects 1 or 2 setups with clear tape confirmation, minimal risk, and disciplined stops. Successes are modest, but consistency and process rebuild confidence and control. Small gains compound over time into both account recovery and psychological reinforcement. This is the operational advantage of micro-trading as a continuation of the patience protocol. Micro-trading also sharpens tactical skills. Each trade reinforces reading of tape, recognition of risk-reward ratios, and adherence to stop-loss discipline. Errors are minimal, easily identifiable, and correctable before they escalate. Each executed microtrade is a controlled experiment in probability, reinforcing learning while protecting capital. The professional's mindset becomes process-centric. Rules dictate action, not emotion. Amateurs, in contrast, continue to pursue ego-driven outcomes, often ignoring feedback until losses accumulate. Another important consideration is scaling. Professionals scale only after consistent rule adherence is proven. They do not escalate position size after minor wins or perceived recovery. Scaling without validation is a shortcut to impulsive behavior, often erasing gains from micro-trading sessions. Micro-trades serve as a litmus test for readiness. Only once the trader demonstrates disciplined execution repeatedly does scaling become viable. This preserves capital, confidence, and emotional equilibrium. Consider cumulative impact over a session. Micro-trades after a loss streak, when executed with discipline, slowly rebuild both account equity and psychological resilience. Each trade reinforces the pause, patience, and reassessment protocols previously implemented. Amateurs fail to see the compound value of disciplined execution, chasing immediate recovery. Professionals leverage small trades to rebuild structure. Confidence rises, losses diminish, and probability becomes aligned with action. Over weeks, the difference between a disciplined micro-trader and an impulsive amateur is dramatic, measurable, and repeatable. The nested psychological loop is critical. Patience establishes readiness. Micro-trading consolidates discipline, and repeated success reinforces confidence. By chaining these behaviors, professionals create resilience that shields against future streaks. Each trade is both an execution and a psychological checkpoint. Emotional volatility decreases, cognitive clarity increases, and account preservation becomes habitual. Finally, micro-trading reinforces a professional identity. Each small, disciplined trade signals mastery of process, not the market. Amateurs act on ego and desperation. Professionals act on rules and probability. Over time, this reinforces confidence, stabilizes performance, and establishes a repeatable framework for success. The account grows cautiously but consistently. Psychological resilience strengthens, and streaks no longer carry the same threat. By the end of this framework, the takeaway is clear. After patience comes precise, disciplined action. Small, high-probability trades restore confidence, rebuild capital, and reinforce process. They teach the trader to value rules over ego and probability over impulse. Micro-trading consolidates mental gains from cooldown periods, creating a repeatable loop that protects both account and psychology. Chapter 5 will reveal the ultimate paradox. Even after mastering patience and tactical micro-trading, streaks can still occur, but the two-loss wall is no longer threatening. The professional is prepared, disciplined, and resilient, turning what was once a barrier into a predictable, manageable phase of trading. Even with discipline, streaks happen. Losses are inevitable. Here's the paradox. The two-loss wall exists not to punish, but to teach. Professionals recognize that losses are feedback, not judgment. Amateurs internalize them as failure, letting fear and frustration dictate their next move. The key to breaking the two-loss paradox lies in combining everything we've covered: stop and reset, patience, and micro-trading. Each element alone helps, but only together do they neutralize the psychological trap. The wall is not a threat when you execute the full sequence. It becomes a structured checkpoint, an opportunity to reinforce discipline, restore control, and rebuild confidence. Consider Livermore's sequence: 4 consecutive wins, followed by a 5th trade that was not continuation but reset. The market did not change. His readiness did. That 5th trade serves as a historical illustration of the two-loss wall's modern equivalent. Even the most disciplined traders encounter moments where psychology shifts faster than probability. The lesson is clear. After 2 losses, implement all protocols, pause, reassess, micro-trade, and the wall loses its power. It's no longer a barrier but a signal, a cue to act with precision and process rather than impulse. Professionals see this immediately. Amateurs stumble blindly. The final protocol consolidates the steps into actionable, repeatable behavior. Step 1. 2 consecutive losses. Stop immediately. Do not negotiate. Step 2. Reset mentally. Step away from charts, journal your emotions, cool down, and let both mind and body stabilize. Step 3. Return only under strict criteria. Setup must align with tape. Risk must be measured. Stops must be logical. Step 4. Start micro. Focus on process, not payout. Position size is small, stops are tight, and probability governs action. Scaling comes later, after discipline and confidence are confirmed. No shortcuts. Each trade reinforces rules over ego, process over emotion. The psychology behind this sequence is crucial. After losses, dopamine and cortisol spike, pushing amateurs toward impulsive trades. Professionals use the protocols to neutralize these chemical distortions. Patience and micro-trades are not passive, they are preemptive, tactical, and protective. The mental reset converts a vulnerability into an advantage, allowing the trader to approach subsequent opportunities with clarity and composure. Each small gain compounds, rebuilding confidence without risking emotional overexposure. Consider a modern example. A trader hits 2 losses in a morning session. Instead of forcing recovery, he stops immediately. He steps away, journals fear and frustration, and cools down. When he returns, he identifies a micro-trade with perfect alignment. Tape confirms direction. Risk is controlled. Stop is precise. The trade profits modestly, but the gain is secondary. The true value lies in reinforcing process, rebuilding confidence, and restoring discipline. Contrast this with the amateur, who trades larger size impulsively, chasing recovery, and compounds losses. The difference is not luck, it is systematic execution of the two-loss protocol. Notice the nested loop. Stop and reset leads to mental clarity. Patience converts waiting into a position. Micro-trades consolidate confidence, and process reinforcement prepares the trader for future streaks. By applying the full protocol consistently, even inevitable loss sequences no longer threaten account integrity or psychological stability. Professionals thrive in this framework. Amateurs remain vulnerable to spirals. Discipline becomes habit, and each test in the market strengthens the trader's system. The maxim for this chapter encapsulates the principle. The market tests your discipline, not your luck. Pass the test, and profits follow. It is not the loss itself that matters, but the response. Every successful application of the two-loss protocol compounds skill, patience, and account protection. Every impulsive reaction erodes capital and confidence. This is the essence of the professional-amateur divide. The professional sees opportunity in structured discipline. The amateur sees desperation and fear. Breaking the two-loss wall also demonstrates the compounding power of small adjustments. That minor pause, that micro-trade, that adherence to rules after the second loss. Each is a lever that prevents spirals across an entire trading career. Discipline compounds. Impulsiveness decimates. The moment you internalize the protocols, streaks no longer control you. You control how streaks affect your account and your psychology. Actionable takeaways consolidate the lesson. Cut losses fast, size small, wait, and own your process. These 4 principles summarize the cumulative wisdom from every prior chapter. They are not theoretical, they are directly executable steps that neutralize the most dangerous trading impulses. Traders who internalize these steps protect both capital and psychology, ensuring that the two-loss wall becomes a predictable, manageable phase rather than a destructive spiral. Finally, this conclusion also bridges naturally into the next step of mastery. While the two-loss wall can now be managed, markets present further challenges, pyramiding positions, and confirming trends. The professional mindset, pausing, observing, and micro-trading with discipline, lays the foundation for these advanced techniques. In essence, today's lesson on breaking streaks is a prerequisite for long-term compounding of both skill and capital. Master the two-loss wall, and every subsequent protocol builds on a foundation of confidence, patience, and process. By the end of this chapter, the nested loops close. Stop and reset neutralizes immediate danger. Patience converts waiting into strategic advantage. Micro-trades rebuild confidence and process. And discipline compounds over time. Loss streaks still occur, but they no longer threaten accounts or psychology. The professional emerges resilient. The amateur remains reactive. The final truth is clear. The market is a test of discipline, not luck. Pass the test consistently, and profits follow, naturally, predictably, and repeatably.